Very good morning to all of you. Welcome you all to the fourth section of TIE Facts. So today the first half of the session will be on sources of finance, part 2, and it will be handled by Mr. Kannan, who is a chartered accountant and a partner at RKRV Associates. And the second half of the session will be on practical aspects in GST. And this will be handled by Mr. M.S. Jagan, an independent consultant and the ex-CEO of S&S India Private Limited. So on behalf of TIE Chennai, I welcome you both, sir. Thank you. Now I request Mr. Kannan to take over the session. Thank you.
Thank you, Sarah. Good morning, friends. Once again, welcoming you to fourth session of TIE Fact. Just a quick recap. Third session was about various government benefits and the sourcing of finance. Since the coverage was very vast, we thought we will take some part of it in the fourth session. That is why we have sources of financing, part 2. And for the benefit of those who have attended, a quick recap, and for the benefit of those who are attending only today, probably an update on what we have seen in third session. Third session, we have covered Startup India registration and various benefits under Startup India. Then we discussed about loans available from SIGB. Then we have also discussed about startups versus COVID-19 repository of information, where we have discussed around 15 to 20 agencies which are helping the startups which are handling corona issues by way of loans, grants, and also equity. We have elaborately seen the various relaxation announced by government with respect to TDS, advanced tax, GST, PF, ESI, and investment for deductions, and some company law matters. And we have seen few popular loans which you can get from the banks covered by various schemes. For example, Mudra loan and Stand Up India loan, Needs loan. Then from there, we also discuss about Atal Innovation Mission and how it is operating through various incubation centers. Once you approach the incubation center, what type of benefits you can get. Then we slightly touched upon the other sources of finance, how you can raise equity, and what are the various debt sources are available. And we have discussed about TRED's platform, Trade Receivable Discounting System. There were a lot of questions. Due to shortage of time, I told I will take up many questions in the subsequent session. And today, I'm starting with answering some of the unanswered questions of the last session. Maybe first 15 minutes is devoted for answering those questions. So Sarah, all fine? You're able to hear? Audio, video, everything is fine?
Yes, sir. All.
Okay, yeah. Okay, so a lot of questions came, nearly 30, 40 questions have to be answered. One question is, can you add few more points on the fact that restaurant retails which had got registered with Startup India? Yes, there are a lot of restaurants and retails have also got registered with Startup India. As long as you fulfill the conditions of company type, annual turnover, original entity, and its a model is innovation and scalable, you can get registered as a recognized startup. Till date, nearly 30,000 startups have been recognized by DPIIT. And in the food and beverage industry, there are over 3,000 startups in the Startup India. And in the retail industry, there are over 2,000 industries that are in Startup India. So that means there are no restrictions that you should not be, or restaurant, food and beverages, retail cannot be part of Startup India. That is possible. Some of the startups in Startup India relating to retail industry are Bombay Shaving Company, Q-Card, Billings Bargains, Hello Delivery. Some of the restaurants which are there in the Startup India is Rose Restaurants, Nostalgia Restaurant, Oyaka Restaurants, Royally Restaurants. Of course, I'm not giving all these details on my own. These details are available in the Startup India site itself. I think I answered this question whether restaurants and other things are eligible to be recognized. I think it can be registered and recognized. Next question, my company was incorporated in 2017, but we did DPIIT registration on 2019. Is a tax exemption will be available to me in 2019 onwards? See, it's very clear. The income tax exemption, the tax holiday is available for 3 consecutive years out of the first 7 years of incorporation. Since you have incorporated in 2017, that means for 7 years, it's 2024, you can claim 3 years tax exemption. Since you have registered with DPIIT in the year 2019, still you can get the tax exemption for year 2020, 21 and 22. All these 3 years are within the first 7 years of incorporation. I think that clarifies your query. Many people raise this question because many people were not aware that they get income tax exemption when they registered with Startup India. So many people have registered only after coming to know about it. That means they would have lost 2 or 3 years of incorporation before getting registered with Startup India. Even in those cases, 3 years out of 7 years, if you are only 3 years old, now you have still another 4 years, you can claim exemption for 3 years. I think that clarifies your question on whether you are eligible for exemption. Kindly let us know the benefits on proprietorship form. The question is, generally, are you talking about what are the benefits of proprietary form, or what are the benefits under Startup India for proprietary form and other schemes? Assuming the question is what are the general benefits, proprietary form, it's very simple to operate, not much of registrations and other things. Of course, GST, PF, BSI when has to be done. There is no need for registration of the proprietorship as such, and the decision is yours. So nobody is going to interfere in your business. There are certain benefits. Of course, there are certain drawbacks also. We have to see that separately. But assuming this question is about whether it can be registered with Startup India or other scheme of benefits are available. First, to register with Startup India, your proprietorship cannot be done. It has to be a partnership firm or LLP or a private limited company. Are the government benefits available? See, the various loans and benefits they give, they don't exclude proprietorship firm. They only talk about entrepreneur. So even a proprietor or a partnership firm or company, you are also eligible along with partnership firm and proprietorship. Startup India is applicable only for manufacturing and service industry. I told you again and again, they have not specifically excluded anything. What they have mentioned is the company should work towards development or improvement of a product, process, or services, or have a scalable business model with higher potential for creation of wealth and employment. And sectors to be registered under this are not specifically mentioned anywhere. Company has to fulfill the basic criteria. Once you fulfill that, you can get recognized as a registered startup. And still you have any queries, very simple, just go to Startup India site. The registration process is very simple. Most of the cases, it is getting recognized. We have not come across any rejections in that. Next question, DP-IIT registration is sufficient for availing all benefits. Registering with DP-IIT is the first step. Once you do the registration, you become a recognized startup. That automatically gives you few benefits, like 5-year self-certification on the labor laws and environmental laws, and various other benefits we have seen. But there are 2 benefits for which you have to specifically apply and get it. One, 3 years income tax exemption. You have to apply and get it from Inter-Ministerial Board. Once again, the application process is simple. You can do it through the Startup India site itself. Second benefit is angel tax benefit. Once again, it doesn't come straight away. You have to go to Startup India site and file a form called Form 2. It's a declaration. Once you file the declaration, you will get a communication from CBDT stating that your startup is exempted from angel tax. So just by registering, will you get all the benefits? No, just by registering, you will get few benefits. But 2 crucial benefits of income tax exemption and this angel tax exemption, you need to specifically apply and get it. Again, the registration is not a cumbersome process. It's a very simple process. You can do it on your own. Move on to the next question. Are there schemes for sole proprietorship organization with people working less than 10? As I said, any loans which are available, they have not excluded proprietorship firm at all. It is for buying a plant and machinery or for working capital. So either a proprietor or partnership firm or a company doesn't make a difference. Of course, there are certain loans where you cannot be a corporate. There's a loan called needs where you say you should be a partnership firm or a proprietor, not a corporate entity. But only for registration with Startup India, you cannot be a sole proprietor. It has to be a partnership firm, LLP or a company. Next question, any age limits for DP-IIT? Once again, it is given in the very first session itself. An entity shall be considered as a startup by DP-IIT up to 10 years from the date of incorporation. I think it's very logical. If you go beyond 10 years, then it is no more a startup. Are there any scheme for small retailer? Once again, those loans and schemes which I've explained, they do not exclude any retailers or anybody. For example, Mudra loan, you just approach a nearby bank. They don't exclude retail or small traders because all these loans are aiming at giving a benefit to get a plant and machinery or as well as working capital need. Probably working capital need is there in the even retail segment. Startup India scheme, any manufacturing industries, sir? Yes, manufacturing industries can also be registered with Startup India. Next question, as a sole proprietor, am I eligible to any government scheme? Whatever government scheme we said, it doesn't exclude a sole proprietor. It talks about entrepreneurs, that's all. I have seen a lot of individual entrepreneurs are getting Mudra loans and CGT MSc loans. It doesn't say it has to be a company or partnership firm. Is there relaxation for traders and retailers? I have come out with the list of relaxation government has announced. The relaxation spread across various areas like GST, advanced tax, TDS. It is there for all the business people. It doesn't exclude proprietors. Please understand, it doesn't exclude any particular industry or something. It is applicable for everybody. I'm just getting few more questions. Let me go through those questions after this session. First, let me answer these questions. Sir, is the Sabka Vishwas scheme for legacy services tax inputs? Yeah, like Vivad versus Vishwas scheme, they have extended time. Same way for Sabka Vishwas scheme also, they have extended time up to June 30th. Can partnership trading avail startup? As you said, it doesn't exclude a partnership firm or trading. It is for plant and machinery or working capital. Relaxation by government. I think we have seen that in elaborately last week. Then somebody has asked about PMBVY scheme. Please explain. It is basically a Prime Minister's scheme for pension for aged people above 60. What happens? You can get monthly pension of 1,000 rupees or monthly pension of 10,000 rupees by paying a one-time payment. For example, you can pay one-time payment of 1.5 lakhs. Then you will get pension of 1,000 rupees per month. And you can pay one time of 15 lakhs. You get 10,000 rupees pension per month. It is for people who are above 60. They see that the interest fluctuations do not affect your revenue. They get around 8% interest irrespective of any changes in the interest rates. So to protect the welfare of the senior people. Does any private company registered as a startup India given a tax holiday for 3 years? How to process? Very simple. The moment you register and get the inter-ministerial certificate, just share it with your auditors. They'll be able to help you to claim this exemption for 3 years. Can a newly registered private limited company which is yet to be operational can register with Startup India? In fact, whoever is registering a company, as soon as they get the incorporation certificate, we also tell them go and register with Startup India. That means it is not necessary that you have to start running the business, then you go and do the registration. The moment the company is in place, with the memorandum of association, articles of association can be filed and you can get the startup recognition. GST 3B interest 9% is applicable after the extended period 30/6/2019. As of now, the time limit is given up to June 30th. There has been a lot of representations to extend the period. There are also representations to waive the interest. We have to wait and see what government announces. I got Angel tax exempt only. I did not get it. I will try to get your email and contact you. Not able to clearly understand your question, but you said you will contact me. You can get my email ID from TRI Secretariat. You can always send me an email. I'll respond. What is considered as innovative product in Startup India? I told you, you have a good manufacturing or service providing or any company there which can create employment opportunities or which can be scaled up, whether you use technology or even not. If you think the company can be scaled up, it can be registered. They don't specifically say what type of innovation or something. It is also not talking about any specific sectors. All sectors can be registered with Startup India. Then there are a few questions about patenting and other things. I need some legal help to answer that. Please take my email ID from TRI Secretariat and send me an email. I'll be able to answer those questions. Is there any consideration we have to make before applying schemes based on equity grants? See, I have listed out various sources from which you can get the grants. And incubators, they give you grants. You have to become an incubating company. That means you have to apply to them, get incubated, then you may get some equity or grant. And equity, they might take a small stake. Grant, generally, they don't take any stake, that you are supposed to spend it as per the direction of the granting authority. Next question, are startup loans available for greenhouse and mushroom cultivation? Yes, from the data available in Startup India, it has been observed there are companies carrying on the business of greenhouse and mushroom cultivation that has been recognized as startup and granted funds. Some of the companies are Annapurna Mushrooms, Doctoral Mushroom, SSR Mushroom Agri-Pro Enterprises, Agri Greenhouse Solution Private Limited. Once again, all these are all startup recognized by DPIIT. The information is available at Startup India site itself. Can textile retail business avail startup benefits? As I said earlier, it doesn't exclude any segments. In case if there is a doubt, application is a very simple process. Apply and see. And we have not come across any rejections. As long as the business model is scalable model, it can lead to good employment creation. I think they recognize your startup as a recognized startup. Loans available for training institutions. One such institution, ISFC, Indian School Finance Company Private Limited. And there is also National Skill Development Council. There are a lot of schemes are available. You can just do some search and you will be able to get that. Any scheme for retailers for increased working capital, all the government loans, they don't exclude retailers. They say plant and machinery and working capital. And Mudra schemes are also available for retailers. Next question, starting a startup with just an idea without a company. For registering with Startup India, you should incorporate the company. Either it should be a company or partnership firm or an LLP. So the entity should be there. Once you have the entity in place, then you can register with the Startup India. Next question, angel tax exemption to be applied before reaching out for pitch to angels. I will answer it in two ways. 2 years back, a lot of companies got notice for angel tax. So that time, many of the startups, they have not even applied for angel tax exemption. Then as government has announced that you can file Form 2 and file this declaration, you will get angel tax exemption. So all these companies which filed the Form 2, they got notice from, letter from CPDT stating that your organization is exempt from angel tax. So they have used it, they submitted to income tax authorities and the notice was withdrawn. It was favorably decided for the assessees. Now, the moment you have the entity in place and you know you are going to raise some money, better file your Form 2 and get the letter from CPDT and tell your investors that your company is exempted from angel tax. So if you issue shares at a premium, it won't be questioned. It protects the company's interest as well as the investor's interest. So my suggestion is to get the angel tax exemption even before going for investment. Once again, it's a very simple process. You can do it on your own or you can take the help of your auditors who will be able to do it for you. And there are also NSDC schemes. In fact, one of the participants has given an answer for a question whether any schemes are available for training institution. The answer has come from one of the participants, that is NSDC NSDC, National Skill Development Council. You can just go through that site. There are a lot of information available on that. So basically, these are the questions which are unanswered in the last session. So I have taken efforts to answer almost all the questions, and few questions were not answered because I require some legal help on answering certain questions. And one or two questions I need to get some information to answer. So in case your question is not specifically answered, please feel free to send a question to me through TIE Secretariat. I'm happy to do research and answer that. And any schemes when you are applying, you'll be able to do it on your own with the help of your accountant or an admin person, or your even auditors will be able to help you. If you are getting stuck somewhere, once again, you are most welcome to contact me through TIE Secretariat. We'll be able to help you in making any application or giving more clarity on how to get the benefits. I think this is about what is the unanswered questions of the last class. Now we'll move on to the part 2. Just an information. Today we have 2 sessions. First 60 to 70 minutes is going to be handled by me on this area. And last 50 minutes will be handled by Jagan. We'll be handling practical aspects of GST as well as what he left in the second session. It's on capital budgeting. And we are not able to complete all the aspects of finance in this class. TIE Chennai has asked us to be extended by 1 more session. So next week we'll have 1 more session in case there are certain areas which you are not able to cover today. Now let us move on to various sources of financing as a continuation of the last class. Sources of finance, part 2. So there are 2 sources of finance. One is equity, that's capital. The second one is debt. You just see the equity. Equity can come from promoters, because when somebody is starting a company, they first need equity. The promoters can bring in that equity. Next step, there'll be family and friends, because you can resort to your family and friends to get some additional capital. Now you think that is also not enough. You need to work on the product development. There are seed investors, you can approach them. Of course, product is ready, then you need to get it to market. Then you need some angel investors to come in and help you by infusing some equity. You have used the angel investors' money. Now product is established. You are able to reach out to the market. Now you want to really scale up. Then you can go to the venture capitalist. Then there will be strategic investors. And if you want to really scale up next level, you go to private equity. And the last level is IPO, initial public offer. These are the various stages in which you raise the money. Now, various sources of equity. I just got some information. One is you can get equity from accelerator or incubators. You can get seed funding up to 50 lakhs. Some of the incubators are CAIE, Venture Center, NSRCL, SINE, and IITM Incubation Cell. There are accelerators, Axelar, Fire and Startups, Surge, Y Combinator. Once again, actually, you don't have to really note down this because they're all information available. Angel networks and platform, you can raise money up to 50 lakhs to 7 crore on an average. This is seed and pre-series A funding. What are the various angel networks? The Chennai Angels, it is there in Chennai itself. You can go to Chennai Angels website and see they've invested in more than 50 startups. Then TIE India Angels, this is another initiative of TIE India. So all the charter members of various chapters of TI in India can invest in startups. They got a forum called TI India Angels. So you can approach your local chapter, you'll be able to get guidance on that. Then there are other organizations called Angel List, Let's Venture, Indian Angel Network, Venture Catalyst, Native Angels, Mumbai Angels, and Hyderabad Angels. The list is not final. You have multiple sources available. Then once again for seed funds, you have 314 Capital, Axilla, Bloom Ventures, India Quotient, K Capital. Okay, after reaching out to seed and angel funds, you want to go to the next level, you want to scale up, then you need to obviously go to a venture capitalist. Now they can give you up to from 2 crores to 70 crores. Some of the VC funds are Axel India, Bloom Ventures, Phoenix India Quotient, Kalari Capital, Matrix Partners, Safe, Stellaris Ventures, PH Capital. Then growth stage fund, growth funding of 70 crores and beyond. You have Fundamentum, Iron Pillar, Lightspeed Ventures, Nexus Ventures, Sequoia Capital Funds, Safe, Tiger Global. Then mega funding investors, you have growth funding of 150 crore plus. You have Alibaba, GST Global, Naspers, SoftBank, Street View, and Tencent. I can also refer one of the charter members, Arun Natarajan, company Venture Intelligence. Any details about those funds, investors, all the details are available. Probably you can approach them, they'll be able to help you on that. Then there are SME focused private equity investors. Then social impact funds like Avishkar, Dell Foundation, Elevar Equity, Gates Foundation, Low Capital. Then after seeing equity is the first source where it comes as a capital and there is no interest involved on that, and it's a risk capital. You invest or get from family, friends, and angel investors, VCs, and other things. One question is asked in the last class: what are the expectations of these angel investors? I didn't cover that in detail. Since we are covering about sources of finance today, I thought I will talk about it. I'll take 5 minutes to explain what are the expectations of the angel investors. So as an angel investor, they would like to really help you, and they would want you to use the money properly. They will expect that this money is used for scaling up so that you go to the next round of funding using this money. So what are the expectations? First one, a business model. Ventures with unique ideas with potential for rapid scalable growth in reasonable time frame. So business with proprietary technology and early market lead and a strong barriers to entry. This is a basic criteria for an angel investor to select your organization for investing. Because you want to be a market leader, they want a strong entry barriers. If there are no entry barriers, then there'll be thousands of people who are doing the similar business. There's no differentiation. The second, what is the need it is addressing and what is the problem it is solving? So what is a business? Business should address a need. Just have a coffee or a meal. It's all a need. Like that, human beings have got a lot of needs. So which need you are addressing? And what is the problem you are solving? The problem you are solving is a big problem. That means you have got a good business on hand. So you should clearly say what is the need you are addressing or what is the problem it is solving. Then you should explain how do you address the need and how do you solve the problem. Then who are your target customers? What is the revenue model? Where is your revenue coming from? What are the different streams of revenue? Then differentiation. Comparing to others, you should have a differentiation because you will attract more customers. People come to you because there is a differentiation. It's also like one more player, then scalability will be a challenge. So you should have the differentiation. And what is the total addressable market size? Because your growth depends on what is the market size. The market size itself is very small, then even if you have a differentiation, you will not be able to scale up. Then competition landscape. Who are all the competitors? Compare yourself with competitors and what are all your plus? What way you are ahead of your competition landscape. Then entry barrier. You talked about it. You should have some entry barrier so that anyone cannot just like that start this business. Probably maybe for the technology use, IP you have, product you have developed, there should be a strong entry barrier. The next thing they see is traction. Traction is entrepreneurs who can provide evidence of the validation of the concept, and particularly those who have begun to engage with the market have a stronger proposition. That means what is the traction in terms of revenue? How much revenue you have raised? The non-revenue matrix, how many customers you have, how many repeat customers, what is the stage of the product, how many products you have developed. These are all non-revenue matrix. So this is all about traction. The traction shows that, okay, you have arrived. You have proved something. So I can believe in your product and invest. That's the purpose of traction. Then there should be a credible exit strategy for investors. How are you going to give an exit? That means, is the exit going to happen in the next round of funding? Or will the company buy back? What is the exit strategy? That means you should not talk about who are all the VCs who might be interested in this company. Because only when next round of fund comes, there is a possibility of exit for these investors. Then they'll expect what is the capital infused and deployment, how much you have invested, how did you spend? What is the current cap table? For example, you have 100% equity, how much is owned by you? Are you owning 90% or 80% or you are owning only 50%? Because your cap table is very vital. A very early stage, if you have very less percentage, it may not attract investors' interest. When you go to angel stage, they will expect you to have at least 90% with you, at least with the promoters. Then what is the capital expected and the proposed deployment? When you are raising money, how are you going to use that? How are you going to deploy? You should have a clear plan of action on that. They don't actually fund for repayment of the loan or repayment of any unpaid statutory dues or anything. They want to use the money for the development, maybe for marketing or building a team or product development that should help you to scale up. Then you should have a business plan or financial projection for next 3 years. Very realistic projections that should tell you, that should clearly explain where will your business be after 3 years. Then expected valuation, a reasonable valuation that fits within the risk or reward expectations of our members. You can't give a very high valuation where the investors get a very less percentage. Same time, you cannot dilute so much because you should hold good percentage of equity when you go for the next round of investments. And what are the general interest in the space from venture capitalists and other investors? It's not VA, it is VC. Typical business have been already funded. Then they know, okay, in this space there is an interest among the VCs, so we can definitely invest. Then the most important is promoter and the team. A strong management team to execute the business plan with relevant and successful experience. A team with a desire for mentoring and coaching. So I just shared around 15 points, out of which 3 or 4 will be very critical, like your business model and the team and the scalability and entry barrier, exit possibility. These are all critical out of this 14 or 15 which I have shared. So we have seen about equity as a first source of financing. Just to recap, it comes from promoters, family friends, angel investors, VC, strategic investors, private equity, then IPO. Then we'll move on to debt. Debt is something you get a fund and you have to pay interest and you have to repay the money. It may be for a specific period. So the difference between an equity debt, all of you must be aware. So how will you get the debt? Once again, there are various sources. One, you may get loan from the directors. As a directors, I think when the immediate requirement, generally most of the companies, only the directors or promoters bringing the loan. Then you have some shareholders, you can take loan from shareholders. In all these cases, there are certain restrictions. Up to certain percentage you can get. You cannot go beyond a certain limit. Then you have loan from corporate. Then you have loan from banks. In fact, most of the companies will have some form of loan from banks. Banks might give you a term loan, or it can be cash credit or overdraft. Then you have non-bank guarantee and letter of credit. And banks, most of the time, they ask for the collateral security and they also ask for the margin. That's where for a lot of startups, when you go under government schemes, they don't ask for any collateral. For example, Mudra or CGT, MSC, they don't ask for collateral. But otherwise, all the banks will ask for collateral. Then you have loan from NBFCs, non-bank finance companies. So they play a very vital role because comparing to banks, the loan sanctioning happening very fast. Most of the time, NBFCs, there may not be a requirement for a collateral security. We are able to get a lot of loans without collateral security from non-banking finance companies. Okay, when we talk about non-banking finance companies, earlier we used to identify a non-banking finance company, go to the website and apply. Now there are a lot of fintech platforms. They are aggregators of these NBFC loans. Just you go to one site, they will find out what is your requirement as per the amount and your financials, and they will suggest which NBFC will give you funds and what period. So they take care of these responsibilities. Some of the NBFC platforms are Finance Buddha, Credit Mantri, Flexi Loans, Inara Capital, Lending Card, Bank Bazaar. Now, any MSME or any small company which is having some financial difficulty right now, they can approach these platforms and give your requirement and give the information they are asking for. There are multiple schemes they have to address the different needs of the different type of companies. You'll be able to take some business loans from this. Then there are a lot of peer-to-peer lending platforms. P2P lending platforms connect borrowers with individuals. And all these people come together. There is a platform, there is a borrower, there is a lender. And now it's organized, it is done under the guidance of RBI, it's all licensed, it's all registered as NBFCs. Some of the peer-to-peer lending platforms are FATSend, OML P2P, Lending Club, Finzi, I2I Funding, Cash Kumar, Lendbox. All these peer-to-peer lending platform will be very handy when you want to take a loan. And each lender can lend maximum of 10 lakh. There are certain limitations. You can't lend beyond 10 lakhs or something. A borrower also cannot borrow beyond 10 lakhs in all the platforms put together. Most of the time, the loans are 50,000 or 1 lakh or 2 lakh like this. The interest rates are generally higher than the NBFCs when you directly approach. And the platforms is responsible to recover the money from the borrower and repay. Generally, they open a escrow account. Borrower deposits in the escrow account. Once again, lender repayment happens to the escrow account, and the lending platform facilitates the transaction, and they get a small percentage of commission for this. But the responsibility is to collect from the borrowers and repay to the lender. 。 . 。  . 。 . 。 . 。 . . . . 。 . . . 。 . . 。 . 。 . 。 . 。 . . . 。 . . 。 . . 。 . 。 . . . 。 . .
。 . . . 。 .
。 I think I spoke about this in the last class also. TRED's platform, trade receivables discounting platform. A lot of companies which have raised invoices to the public sector undertaking or large corporates where they have 60 days credit period or 70 days credit period, they can discount the invoice in this platform. And there will be financiers who will fund these invoices. This is what is done by TRED's platform. Right now, there are 3 platforms available. I've given the details in the last class. So a lot of MSMEs, they are not able to get any government grant or anything. They are not able to raise money. They can see this option, whether they are able to get something in the TRED's platform. Then the next is incubators. We have discussed about this in the AIM, Untitled Innovation Mission also. There are hundreds of incubators in the country. Once you become incubatee in an incubator, you have multiple benefits coming to you. They'll give you the shared support services, mentoring, training session. They'll give visibility to your organization, the eyes of the investors. A lot of colleges have these incubators, and they are also able to help you get grants announced by the government. Then we have already seen about debt funds. There are a lot of debt funds. Then a lot of ministries have got the grants. SIGB loans, we have elaborately seen in the last class. 3 specific loans are available from SIGB for Corona: SAFE, SAFE Plus, and CASS, Corona Assistance for Startups, or Corona Startup Assistance Scheme. Apart from that, there are multiple schemes available under SIGB. So I'll just give you 2 minutes break. Probably if you want to note down something, you can just note down. Then we will get into other area, which is various touch points where you can increase the cash flow. But just take 2 minutes break. Meanwhile, I'll go through the questions. Okay, I'm also going through these questions. Now, after I hand over the floor to Jagan, say after 15 minutes or 20 minutes, then he'll be handling a session. Then after he completes, if there is time, I'll be able to answer certain questions. And you're also thinking of getting one more session from Tai Chennai. They asked us to take one more session. I probably will answer that in the next class. So the next part I want to handle is, it's not about externally raising money like equity or debt. Now within the organization, there are multiple ways you can just increase the cash flow. I'm just sharing this based on our experience over the last several years. how you can increase the cash flow through multiple sources. We call it as a touch points. And not that you are not aware of it. Many times you are aware of it, but we might not have acted upon it. Small ways, at least 40, 50 ways, you can just make some small changes. You'll be able to see some cash flow into the organization. Let us get into that now. Yeah, various touch points, ways you can increase the cash flow. The first one is proper accounting and MIS system. So a lot of companies, they have to do post-mortem in several cases. After 1 year, after 2 years, they find out they have missed a lot of money. They have missed a lot of cash flow. So how do you handle it? The moment you start the business, see that this discipline is followed. You have a very proper accounting and MIS system. Every month, you should be able to generate your profit and loss account and balance sheet and compare it month on month and compare every revenue items, compare every expenses, every balance sheet item. That's very important to manage your cash flow. Because when the audit is done at the end of the year or after 1 quarter or 2 quarters, they give you a report stating that there are revenue leakage, all those things. Of course, it will help you to correct, but if you have missed out something already, you will not be able to recover it. So we should have the discipline of very prudent, perfect accounting and MIS system. Second, pricing. Very vital point. Many times we are not aware, probably we would not have experimented. A small increase in the price would result in a better cash flow. I have seen a lot of companies maintaining the same pricing due to a lot of reasons. Of course, it's a practical issue. The entrepreneur has to decide whether the increased price can be accepted by the market or not. Several times, a lot of organizations I have seen, they have not increased the price. Not that they have any specific reason for that. They have not thought about it. So you should see if you can just increase the pricing even by 2% or 3%. For example, a product is 100 rupees and you make a profit of 1 rupee. Just the product becomes 11 rupees. That means 10% increase in the price. The profit becomes 2 rupees. That 200% increase in the profit. Once you know you have got a good market, because if doesn't mean if you don't increase the price for 3 or 4 years, 5th year, you can give a big increase to the pricing. It's a conscious call. Your board has to think, contemplate, see the industry, competitors, and you can definitely work on the pricing. Again, reduce cost. Many times, conscious effort is required to reduction in the cost. You can just go and check your P&L, go through every expense item. I know you'll be able to definitely reduce your cost when you start comparing that month on month. You need to compare it month on month. That's where you need the MIS system. Every expense you see an ROA is a return on investment. Analyze like that. You'll be able to reduce the cost. Multiple vendors for getting good rates, credit period, and discounts. As an entrepreneur, you will definitely know your purchase department should be very, very efficient. For the same product, if you have multiple vendors, then definitely you'll be able to get a good rate, good credit period, and also discounts. Credit-worthy customers, amount not received for 180 days, 360 days, write-off. Most of the time, when you take a decision at the end of the year, you want to see whether you want to write it off or not. But if you see the origin, why this type of receivables are accumulating, probably you would not have got a credit for the customers. When you go to a bank, when you take a loan, they do so much of credit rating. In every business, ultimately, if your product is really a good product, somebody should be able to pay and get your product. That means you should be able to dictate what type of customers you need. And practical aspects, I leave it to you, but it's worth contemplating on this point. You have to check the credit worthy customers. Then you should be quick in execution. Many times we get the orders, there is a lot of delay in execution. Then I have come across a lot of companies, they would not have raised invoices after completing the job. They say, I want to do year-end closing. That time only they decide that there are a lot of jobs which is executed and they have not raised invoices. Now there are a lot of ERP packages are there, simple SaaS platforms are there, where you can track the work job order. The moment the job is completed, automatically invoice is raised. Next one, after raising invoices, there is no proper collection mechanism. Once again, you should be able to have a systematic follow-ups. Leveraging on the fixed deposits. Many companies have this 30 days, 60 days, 90 days fixed deposits. So if you have some immediate cash requirements, you can always take a loan on the fixed deposits and repay the loan at the earliest. You might ask me, why should I pay 2% more? No, it's only for a short term. Say next 30 days, 40 days, you'll be able to get the money, you'll be able to repay it so that your fixed deposit remains in the bank. Another aspect of fixed deposit is there are multiple interest rates on the fixed deposits. For example, one bank might give even 0.5% more interest. You should be able to use it. Recently, I've seen one person has taken a housing loan from one institution and he transferred the loan to another institution where his EMI has come down by from 34,000 to 26,000. That's a big difference is there. You have to really do some analysis, find out about the interest rate offering by different banks. Same way for fixed deposits also. I have seen every client, there can be 1% more return can come with the fixed deposit to do some analysis. Then monitor FD renewal and closures. Most of the cases, the accounts department might not be aware whether the FD is renewed. Sometimes it is closed and it is not renewed. You realize it after some time. Then there is a lot of money lying in the saving account or current account beyond what is requirement. So that can be transferred to fixed deposit. Or you have next one, flexi deposits. That means it's all a fixed deposit. Whenever you need money, that will be transferred automatically to a regular account so that what is there in the FD, you continue to get interest. Stake in vendor companies. This once again out of experience, we have seen some companies, they have some suppliers, they are able to have some stake in that one that helps them in good rate negotiation and also ensure that there's a consistency in the supply. ESOP to retain employees. This for the benefit of a lot of startups. They are not able to spend a lot of money to retain a good talent. For example, an organization that might only be a founder, a single founder. He needs one more person to manage the organization, but he can't really pay a big amount. ESOP comes very handy in these cases. So ESOP will reduce the cash outflow. You don't have to pay a lot of salaries. Follow up on tedious refunds. Now the government has announced any refund up to 5 lakhs will be disbursed immediately. We have seen nearly 4,300 crore refund has been disbursed in the last 2 weeks' time. You see the balance sheet of your company, you will see TDS receivable outstanding. Sometimes it will be 2 or 3 years old. It will be shown as a current asset. you have to see what is his current asset, TDS receivable. For which year it is receivable, you go and see. It might be not be for the current year, it might be for the last 2 or 3 years also. You just see why it is not refunded. There might be some error in filing or that would not have been followed up. So you have to follow and get the TDS refunds. It's like monopoly game. It all talks about cash flow. You go through one pass and you have to collect the 200. Many times we forget collecting the 200 rupees. There are multiple ways. You have to remember that you should be able to collect those money. Next one is lower TDS certificates. Those who are in the service industry, when you raise invoice on the vendors, generally they deduct 10% as a TDS. So you do a turnover of 3 crore, then 3 lakhs. In fact, your profit margin might be 20%, but TDS is 10%. So it's quite a big amount. It affects the cash flow. Because if the TDS is deducted at 10%, you have to file the returns at the end of the year, then wait for time, 6 or 7 months to get the refund. Sometimes it may even go beyond 1.5 years. So the easiest thing is, at the beginning of the year, you apply with your TDS officer that your total revenue is going to be so much, the total tax is so much, so your tax rate will be only 2% or 3%. And you file a form, you will be able to get an approval for lower reduction of TDS. For example, as against 10% TDS, you may get a certificate that vendors, your customers can deduct only 2% or 1%. Some cases it may even be 0%. Once a certificate is shared with your customers, based on that, they will not deduct 10%. They will only deduct 0, 1 or 2%, whatever is there in the certificate. This has a lot of companies in a very good cash flow. I have seen companies with 100, 200 crore turnover, where 2 to 3 crore is locked up in the TDS. Now they are able to get 2% TDS certificate, at least 1.5, 1.8 crore is released for working capital. Then follow up on the GST refunds, like TDS refund, GST refunds, you need to continuously follow up. Follow up meticulously for input credits. Many startups have this problem when we want to pay the GST, where your vendors have not remitted GST, then you will not be able to take the credit. So what you should do, you should follow up with them so that your GST output comes down, because you are able to ensure that your vendors remit GST on time. Then avoid interest, late fees, penalty by proper payments of dues within time. And see, I just work with few investors or few investment forums, where I've seen a lot of penalty and fees is paid just because the compliances are not in place. So if you see that the compliances are in place, then you can avoid a lot of late fees, interest and penalty. Sometimes you will not even quantify what will be the penalty, because when the action comes from them, you will know after 2 or 3 years there is a big penalty. So easiest thing is like this. Ensure that statutory payments are made on time. GST, that is not your money, so you are collecting it, remitting it. So it is not our money. TDS is not our money. We are deducting and remitting. That means we are not using our money to remit GST or TDS. It is someone's money we are remitting. So I think it has to be remitted on time. When you have a regular account, bankers give additional facilities. That means your bank account should be very good. There should be no check dishonors. You maintain the inventory statements, receivable statements, submit it on time. Suddenly there is an emergency, you can approach your bankers. I've seen most of the companies, they are all getting additional benefit just because bankers want a good customers. The bankers has got a good customer. Instead of going to a new customer, they would like to encourage the existing customers. So if you are great worthy, if you maintain things properly, any emergency, your bankers will be able to give you some funds. Next, create proper budgeting. Budgeting is very, very important because that helps you to anticipate what is going to be the outflow, what is going to be the inflow. So you can plan well in advance for 1 year. the moment you plan, you will also find out ways and means of addressing the deficit. Probably in March itself, we should prepare a budget for the next 1 year. And afterward, the budget has to be regularly monitored. In fact, you have flexible budget. Every 3 months, you can also revise the budget so that your operations are not affected because of working capital. So like this, I can go on. We have another 30, 40 points on that. Probably if there is one more session, I'll be able to talk about it. So now we are moving to the next session of today's session, next part of today's session. Mr. Jagan is going to handle that. A quick recap of what we have seen is today it started with answering a lot of questions of last session. And I also said even apart from that, if 1 or 2 questions are missed, you can always reach out to me through Tax Secretary. I'll be able to help. Specifically 1 or 2 questions, I need some legal help. I have to consult with my legal team and answer that, especially on your overseas IP patenting and other things. Then we have seen about equity and debts, various sources of equity. We have seen promoters equity, family and friends, then seed equity, angel investors, venture capitalists, strategic investors, private equity, IPO. Then under each category, we have seen who are the people who are investing. Under seed, I have given 4 or 5 companies. Angel, Chennai Angel Network, Indian Angel Network, Venture, Let's Venture. There are a lot of angel groups we have listed. Like at every stage, I have given you a list of investors whom you can approach. After seeing the equity, we have seen about the debts. Debts, first source is a bank. You have a term loan, you have a CC or OD, then you have bank guarantee or letter of credit. Then we have seen about NBFC. Then we have talked about fintech platforms which act as aggregators for NBFC. That's one point of contact, like Finance Buddha, Credit Mantri, Lending Card, one point of contact. They will know your requirement. They'll be able to help you in getting the loan. And they're very successful in doing this because of their tie-up with multiple NBFCs. Then we have talked about peer-to-peer lending platforms, given some examples. Then there's a TREDS platform. Then the incubation centers. Then grants from various ministries. The last one is we have talked about various touch points in an organization through which you can increase the cash flow. I have around 40-50 points on that. We have covered nearly 15-20 in that. Some more there, it's basically some conscious thought process. You have to sit as a team and discuss and spend some time on this. You'll be able to work on multiple touch points on this. And there are some questions which have come up during this session. I'll go through all these things as Jagan takes up the session. Probably at the end of the session, if possible, I'll be able to answer a few questions. So thank you very much for patient listening. And over to you, Jagan. Please take over.
Hello.
Saurav, thank you. And Jagan, you can take over. Thank you.
Yes, Saurav, you got to tell me whether I'm audible and I can be seen.
Yes, sir. You can be seen and your voice is audible. Very audible. It's
so
clear.
can I proceed?
Yes, sir. You can proceed.
Okay.
So can you just adjust your camera a little because yeah, done.
And never mind my face. Yeah, that's good enough. That's all my face. Okay. Good evening or good afternoon to all of you. So today, the last session of today is on 2 things. On GST, basically some compliance issues, more so some understanding issues. And I had left out capital budgeting last time. I had told you that it is a little complicated because it involves something else. I'd like to touch on that right now. We can't complete it. So in case these things get extended and there is time, I can tell you more about it. So let's get started with GST. I would like to share a document from that and I would like to proceed. So can you, all of you, at least one of you tell me, or Saurav, tell me that you can see the file?
Yes, sir, we can see it.
Yes, sir. Yes, sir.
Fair enough. I'm changing the thing. 1 second. Okay, you can now see it. It's on GST. The thing will be goods and service tax. Is that title on?
Goods and service tax.
Right.
Yes.
Now, I think all of you are aware. I'm not going to teach you GST because you have attended some sessions. And if you still don't know, I'll be willing to take it on later. But GST basically is a replacement of some 16 different types of taxes. You're all aware about that. It's also a progressive tax, which means that only value addition at each stage is taxed. The reason I'm telling you all this is because you ought to understand how it works in your daily life, how it works insofar as your pricing is concerned, your costing is concerned. You know, the GST 18% pay, that doesn't help you. And I'll try to tell you exactly how it makes a difference to you and what mistakes you make in costing. Let me come to that a little later. The other purpose of GST is to bring in accountability in all business activity. The idea is that there is no business which is done and not accounted. Munadlam used to call it black money. Now, the idea of GST is you cannot get away because A supplies to B, supplies to C, and it goes on to Z. And if Z wants to take credit right from A to Z, they all have to declare their income. That is the reason they brought in GST. While deciding on the rate of GST, another popular misconception that the GST rate is very high. In that context, I just want to explain one thing in brief. Just have a look at this. Under the old system and the new system, I'm just showing this to you for a brief understanding. I am marked in yellow. I said, let us assume that the earlier tax rate was 7%. And here, if you look at the row O where I've kept my cursor, the new tax rate is 18%. It looks like 7% has become 18%, which means there's a 2.5 times increase in the rate. In reality, that is not so, because if you look at the tax burden where I'm keeping my cursor, in both the places, the tax burden is exactly the same. Now, this is critical for you to understand, not so much from an arithmetical point of view, but from the point of view of how to cost. Let me come back to, just remember this, I will come back this to you later. Let me go back into the presentation once again. Okay, this is called revenue neutral. That means whatever was the tax you paid earlier is the same tax you pay now, total quantum. But because earlier there was a tax on tax on tax, which they have now removed, the old percentage is no longer valid and a higher percentage has come. For example, if you look at where my cursor is, if the previous incidence works out to say 16% overall, it was taken as 18% to round it off. And if the earlier one was 14%, it was rounded off to 12. Therefore, this rounding off led to some increase or decrease in taxes and therefore changes in prices. But let me come to two most important things in GST. The first is ITC. That is input tax credit. And based on my experience with a whole lot of people, not just entrepreneurs, not just small businessmen, even people who are more in the business, I think there is some confusion in understanding how this input tax credit works. I'm going to give you a numerical example later, so you will have to bear with me till then. This must be understood very clearly as it plays an extremely large role in the competitive cost of your product. And I will show you an example where if you don't understand this process, you will cost your product higher than what you should and therefore lose business. And that's why you must understand this. The second very important thing in the GST, which is partly implemented but will get implemented sooner or later after all this tamasha gets over, is called the RCM or reverse charge mechanism. Some of you are aware, but most of you are not very clear on what it is. This again, I will explain as we go by. I want you to remember these two acronyms, ITC and RCM, and we'll go. The third one, which people get completely confused, is nil rated, exempted, zero rated, non-GST. They're all different. Give you an example. Zero rated are export supplies that you make to an SEZ or even the SEZ developers. Those are zero rated. Nil rated is, at the moment, they have got a 0% GST. This can change. There are examples, some examples like basic food materials, salts and grains and jaggery and very, very basic food elements have a rate of 0. Now, if it changes in the future, that is why some food particles will have a higher rate, some package. If you buy oil, which is non-branded, there is one rate. If you buy a branded oil, the rate is entirely different. Exempt. Now, these are taxable, but do not attract GST, for which ITC can be claimed. Leave that out. Those are very, very specific things. And take the non-GST. There are basically 4 items which are not under GST. One of the most popular one is alcohol. Liquor is not under GST. Petrol, diesel, and those varieties are not under GST. Real estate, land, and sale of finished apartments is not under GST. And electricity is also not under GST. So I will repeat: alcohol, electricity, real estate, as in finished apartments, and land are not under GST. Whether they will, and mind you, these account for almost, they say 40% of the revenue that comes to the state and central. So 40% of what we are consuming is not coming under GST. There is a talk of bringing it. We'll worry about it when it comes. Now, the normal thing is, given a choice, and this is very human, we would not like to register with the government and get into this filing of returns, because the minute you register, you have to file returns. And that is never very interesting. So first, I want you to be very clear, because some of you are in an industry where you don't have to register for some time. Some of you will have to register. Basically, what it says is, if your turnover of manufactured product is less than rupees 40 lakhs per annum, or you are in services and your taxation, your turnover is less than 20 lakhs, you are not necessary to register. Please understand, I'm using the word, it is not compulsory to register. Less than 40 lakhs manufacturing, less than 20 lakhs services, it is not compulsory. Now, just because it is not compulsory, does it mean you should not register? Let's go down and have a look at it. So second point, as I said, if I'm below the limit and I do not register and hence do not pay GST, is it okay? Well, yes, legally it is okay. But from a business point of view, it might not be the best thing to do. It depends upon which industry you're in, what is your product, and to whom you are supplying. In other words, you must understand your customer before you decide on whether to register or not. If you have the option of not to register, I will repeat, if you have to register as per law, there is no choice. Then the question is how to handle it. Will reverse charge mechanism affect you? What is reverse charge mechanism? Reverse charge is a part of GST which says, let's say supplier A sells something to B. Now, B is Hindustan Lever, and you are supplying the wrapper of the soap. You are very small. Your manufactured product is less than 40 lakhs. So you don't register. So you sell the wrapper to him. The wrapper you sell at, just for argument, at 5 rupees. You don't pay GST. In a reverse charge mechanism, Hindustan Lever will have to pay the GST on that 5 rupees. And they can take input tax rate. Now, it sounds very silly. They will pay 18% or whatever is the percentage. I'm assuming it's 18. They will pay 18% of 5, which is 90 paisa, to the government. And then they will take credit of that 90 paisa when the final soap is sold. So effectively, Hindustan Lever is not paying any extra GST under RCM. So why do we talk about RCM? Let me come back. I've given one example. If your bill is 1 lakh, you don't charge GST. The company will have to charge you at 18%, pay 18,000 to the government. Of course, they will claim ITC. So by now, the cost to the company is still that 1 lakh. So whether you pay the GST or you don't pay the GST, whether you are registered, whether you are not registered, as far as the company is concerned, it is 1 lakh, 18,000 is the value of what you've given. So your argument with the customer that I am not under GST, so I am 18% cheaper, does not hold good in cases where there is RCM, and RCM will slowly come into all such cases. Even the above is all right legally, no problem. So long as customer gets a competitive pricing from you and the business goes on. Our key word is competitive pricing. Hang on, I will explain where it goes wrong. Once I give you that example, it becomes very clear, but I'm building up to that so that you understand why that is important. If you're not registered, please remember, it cuts both ways. If you are not registered, you don't have to pay GST, but at the same time, you cannot claim any ITC adder. What I mean is, if you are manufacturing some product for which you buy, let us say you buy some small steel item or small cement item from outside and you manufacture. Now the cement attracts 28% duty, the steel might attract 18% duty, but your finished product doesn't attract any because you're less than your 40 lakhs. Therefore, you cannot claim any ITC that you've paid on steel and cement. Don't forget, you are buying steel and cement from a dealer who will charge you GST. So you will pay GST, but you cannot claim ITC. You understand now how slowly you're beginning to understand how the cost of you goes up, which means if you paid GST on anything you bought, it becomes part of your cost. And the whole idea of ITC is not to allow GST to become your cost. Remember, you will, if you still want, you can reduce your profit and give it at a lower cost to the customer. No harm in that, but your profit is going down. So whether that is of any interest to you or not, you must decide. Remember, if your billing exceeds 20 lakhs services, then you have to register. Now I'm coming to the third point. I told you about ITC. I told you about RCM. I'll come to the examples later. Now I'm telling you how everything gets linked. See, in the good old days when we did not have computers, it was very, very easy that the right hand of the government does not know what the left hand of the government is doing. Now, unfortunately, or fortunately, depending on how you look at it, the government has only one hand, which means if you have a question that how will then I will not register, I'm 25 lakhs, but I will not register, then I come to the next aspect. Your PAN number, unfortunately, is linked everywhere. If you are selling to any customer, B customer, remember, you can't do a deal of more than 20 lakhs and 20,000 in cash, and that becomes illegal. So nowadays, companies, in fact, they've stopped paying checks. You will agree with me that most payments are e-payment with rare exceptions. Now, in an e-payment, one of the fundamental things these people will ask is your PAN number. Hence, all payments are recorded also linked to your PAN number. In any case, your bank account is automatically linked to the PAN. Now, if during any scrutiny, you can always argue, my amount is so small, why will they come and scrutinize my account? Those were the days when there used to be manual scrutiny. Now it's computerized scrutiny. So the computer will just run through. Computer isn't bothered and it can do about 10 million things in 1/10 of the 100th of the time. So if it is seen that the money received by you in business exceeds 20 lakhs for service professional concern, then they will inform the GST department that this fellow has done more than 20 lakhs. Has he paid any GST? You will then get a notice from the GST department. These are ideal. Maybe there are gaps in between, but understand this is how the system will work. Remember, those who think you can get away, difficult. Also, if you do register for GST and pay it properly, let me take the other way. The earlier case, you showed for income tax, but you didn't show for GST. I will now reverse the case. You will show for GST, but not show for income tax. Then what happens is, same logic. The GST will then check with the income tax, and the income tax is lower. The income tax will send you a notice. So you can get a notice either from the GST or you get a notice from the income tax asking you to tally. I have done this tallying even as far as service tax is concerned. I have received notices, even service tax, but those cases were more random. I was unfortunate to be picked up. Now it is not random. The computer will almost pick up 90% of the processes that come through. They will do it. So please note where my cursor is. All returns are being crossed, but not cross-like. It's cross-linked using your PAN. And now PAN is linked to Aadhaar. So you understand how you try to run the differences and send notices. There is one point. and in the earlier discussion with the thing, I was observing some of the comments. GST remittance. Now, technically, if your billing is 1 lakh and you raised 1,18,000, it's 18,000 as the GST, then you have to pay the government 18,000. But the problem comes in is you raise the invoice on, let us say, November end, 30th. The customer will, even assuming he pays you by December 23 weeks credit, he pays you by December 20. You have to pay to the government by December 10th. By December 10th, you might not have got the money from the customer. So in effect, you are putting your own money to make that payment. And then you will recover it from the customer. It doesn't come from your profit, but it does come from your cash flow. And therefore, in the case of GST, handling cash flow is extremely critical. I'll come to one point. Let me now take you the example that I was talking about, how things can go wrong in costing. So let's have a look at that. Most of the type of GST, yes, by the way, another thing. So long as you're only selling within the state, there's rules of 40 lakhs and 20 lakhs apply. If you are doing interstate sales, which means you are attracting interstate GST, then unfortunately you have to register. If you do not register, you cannot sell, which is what is, see, if you see below, you have a CGST, you have an SGST and an IGST. The CGST and the SGST are if you do within the state GST and the central GST. The minute you go outside, it becomes interstate GST, which is IGST. For that, you have to register, even if your turnover is only 5 lakhs. So you do one deal with somebody in Madhya Pradesh, you have to register, else you can't do the deal. Again, you must understand all this. This I've already told you: liquor, electricity, petroleum tax. Reverse charge mechanism, I am just showing you what it is. Don't worry about it. I have explained to you how this works. If you're not registered, you cannot make interstate sales. Availing of GST will reduce your. Let me now take example. This is the crucial example which you must understand in the entire process of GST. Take a simple case. Your cost of material is 100. These taxes, these rates don't actually remain, but I didn't want to confuse the arithmetic. So I'm now taking the cost of material is 100 and the GST is 10%. So if you are buying from somebody, he will charge you in his invoice 100 plus 10, 110. Now, if you either have not understood GST or you are not registered, then your cost of material will be taken as 110. Moving on, you add your value and your profit at 20. 110 is your cost. Your value added and profit is 20. Therefore, your total cost now is 130 to the customer. Obviously, there's a GST at 10. If you use it wrongly, if you're not registered, it will not be there. But it will be 130. Your cost will remain 130. But the other GST will not be there. But if there is an RCM, then your customer will still have to pay the 10%. So either way, it is there. And for the customer, in this scheme, if you do it wrongly or not registered, it comes to 143. That is his cost. If you're not registered, automatically, this 13 is not there. 130 plus 13 paid by him is 143. If you are registered, your cost, but wrongly evaluated GST, your cost is again 130. You will pay the GST of 13. He will, of course, get credit for it. Now, why am I saying it's wrong? Let's look at the way of correctly doing it. Same thing. Your cost of material is 100. Your GST is at 10%. No difference here. But now, in the third line, we come to a difference. Cost of material remains at 100. It is not 110. These are for people who are registered under GST. And people who don't have to, I'll explain how it affects them later. So if you are registered under GST, your cost of material is 100, not 110. Now your value added and profit is 20. Same 20. Your total cost now is 120. Earlier it was 130. If you go back earlier, it was 130. Now it's 120. The GST at 10% is now 12 as opposed to 13 earlier. And your cost to customer, this is the most important, including GST, is 132. Earlier, it was 143. So you understand how the customer is effectively now paying 132 instead of paying 143. Of course, he gets a credit for the GST. Why is it happening? Now, imagine if the customer had a choice between a guy who uses it correctly, the guy who uses it wrongly. Who will he go with? Now, why does it happen is, on the third line, that 10 rupees, if you're not registered, you have to consume the 10. The 10 becomes your cost. You cannot take credit for it. In which case, your cost of material will remain 110. This is the criticality. This ITC is the complete criticality. And if you are in a GST and not adopting this, then you are making a mistake. Now, does that mean I have paid 10 earlier and I'm paying another 12? I am paying 22 to the government? Of course not. You now have to pay 12, but you've already paid 10. The 10 is sitting in your credit. So the 12, the difference therefore is I have to pay 12. I've already paid 10. 12 minus 10, I now have to pay 2. So the total GST that I have paid is 10 plus 2, 12. Not 10 plus 12, 22. You understand? I hope the difference is understood. I will take questions on this. This is not so obvious, and therefore you need to work on this or sit with your person who can advise you on this. There are some problems in this. I'm going back to the concept of GST. There are some problems. Let us say you are supplying, I told you there are some items which are outside. So you have to study your customer. Let's say you're supplying something to a real estate guy. Now, the problem in real estate, they've compounded. Let me see if I've taken that with me. Examples of industry without GST on end products. I'm just taking two examples, real estate, apartments. It's also there for commercial, but let's talk about apartments and restaurants. If you remember, restaurants earlier started with a GST of 12%, and everybody screamed saying it is so high, the cost of dosa will go up, vada will go up. Actually, that was very, very wrong. It would not have gone up. But because they screamed so much, the government said, fair enough, I will reduce that 12% to 5% and then put the caveat, you can't claim ITC. You cannot claim any credit. So if you buy from somebody and you pay GST to that guy, you cannot claim credit. It becomes part of your cost. So suddenly these guys found that the cost has started going up. It was too late to do anything about it. Let us take real estate apartments. Hypothetically, you are supplying, let us say you are supplying switchboards, simple manufacturing item. You are supplying switchboards to real estate apartment manufacturers. Now, switchboards attract GST. So you have to pay GST if you are registered. But that end guy, unfortunately, he will have to pay you the GST, but he does not have ITC. Therefore, your GST becomes his cost. As opposed to, let's say you are supplying some services or process to any other manufacturing company. Let's say you're supplying it to Kone Lift. You're supplying some steel manufactured element to Kone. Then the GST you pay on that will be set off by Kone in his end product when he supplies the lifts. So if he can set off the ITC, then he doesn't care what ITC he pays because he can set it off. But if he cannot set it off, then every ITC, every GST he pays is a pain. So you got to understand your customer. So I'm now coming back. If the question was, should I register or not? If you're under 40 lakhs, maybe if you are supplying to someone who is not able to make use of the ITC, you may not register. He is your major customer. But remember, there is no case to case. You cannot tell the GST authorities, to this guy, I will not charge GST. To this guy, I will charge. If you register, you charge for everybody. My last line on this is, please follow the rules and pay taxes. If you're not sure, please contact someone. Again, understand. You also can be in a similar situation where sometimes you pay a higher GST than what you're able to claim. Let me come back. Let's say you're making a cement product. You're paying 28% to buy the cement, making some, whatever is the product you're making using cement and casting, which attracts only 18%. I repeat, you're paid 28% on raw material, some raw material, the cement, but your casted product attracts only 18%. You may or may not be able to set off the entire GST paid, in which case your price, your end price has to reflect that differential cost. If not, it's a permanent drain on your P&L. You've all done balance sheet now. You've done your P&Ls. Let me explain end this thing, and I'll give a break. I think we already spent about 25 minutes on this, so I will give a break to look at some questions. But I just want you to think. When you buy material, your asset side of the balance sheet will get credited. Your inventory level goes up. Now, in this example, when I said 100 plus 10, please remember your material cost in the balance sheet will go up by 100. Your GST advance paid, or any other name that you use, your GST also on the asset side will go up by 10, because your bank balance would have come down by 110. Your balance sheet will tally. Now, as and when you sell and use your ITC, this 10 rupees of GST will start coming down, going up. When you buy, it goes up, and you sell, it comes down, and there's a continuous fluctuation on that. The problem comes if you cannot use the GST, then this 10 rupees will become 20, will become 30, will become 50, and it'll keep on adding on your asset side of the balance sheet. And you look at it and you'll say, what is wrong? It's a good asset. See, my asset side is going up. Well, your asset side is going up with a figure that you can never, ever use, and you will have to write off. So that kind of an asset is of no use, and you must understand that when you sit down. I hope I just made you think on this. At this moment, I will stop here just to see whether there are any questions on GST. And questions can keep coming in. Can you please send screenshots on how to calculate GST? All right, that I will do that separately. I will link it up with Ty, and I'll be able to do it. We are borewells drilling business for agricultural purposes. What is the GST implications of the work done for the improvement agriculture? See, the GST is not based on the end product. It is based on your product. Your drilling businesses, if you're doing borewell, you would not, it's not just agriculture. Your product is borewell. If you can do a borewell for a 5-star hotel, you can do a borewell for an agriculture. The government does not distinguish on that. So the chances are you have to pay the GST for that. If you're doing it for a hotel company where they want an additional borewell done, they may or may not be able to get a set off, but you have to do it to the others. That answers it. In a JV model, should the developer pay? Miralade, this question is a huge question. Anybody is interested, I will send a complete write-up. It is impossible to answer this even in 2-hour session. And there is still confusion, and there is still claimings to be done. So if you don't mind, this particular person who's asked this, I would like to send a complete write-up on this, and we can discuss that write-up as and when it may be required. It is impossible to answer because it's extremely complicated. In this, where MRP will come, somebody has asked me that. Well, the MRP is part earlier on, before GST came, and there was a sales tax, if you remember. And if you remember, in those cases, if you're clearly seen, they'll say MRP in Tamil Nadu, 23 rupees, MRP in Telangana, 24 rupees, MRP in Bihar is something else. In fact, or rest of India. Now, that is because sales tax differed in every state. Every state had the right to charge whatever sales tax they liked on the products. Once GST came in, and that's the beauty of GST, no state has a choice of the rate. The rate is the same for a given product. And therefore, the MRP will include the GST the same way the MRP included earlier the SRP. Biscuit rate for GST and non-GST. A biscuit pack example cost I'm asking. I will not know specifically on biscuit, but I do know for oils there are, one is a 0 rate and one is a higher rate if you're branded. The idea being, if you are branded, then you will attract a higher rate than if you're not. So specific examples I would request you to check up because it's very difficult to handle now. Even if it's less than 20 lakh turnover, GST registration is not compulsory. Yes, this is the point Mr. Chaco, I would like to take your, somebody said audio is feeble. Your audio is okay. I thought the audio is okay. I'm assuming the audio is okay because Saurabh, you have not come back to audio is okay. Great. I'm moving on. Yeah, I was in this. Even if less than 20 lakhs turnover, GST registration is not compulsory, but some companies, precisely the point I am making. You see, when you sell to somebody, you may be a 10 lakh turnover. Your turnover is 1 lakh a month or 1.5 lakhs a month, 18 lakhs, less than 20 lakhs. As far as the company is concerned, they would like you to charge the GST, pay you the GST, and take credit for it. The process of RCM is more complicated for them. It's much simpler for them to give you the GST. You don't have a problem either. In fact, it is good for you. I repeat, if you pay GST, you can claim the GST, and that's could be another reason why this company is forcing you. The company might say that you can reduce the cost of your product because you can take an ITC credit and therefore reduce the cost. Give me a better price for your product and charge a GST. If not, your cost is higher. I'm paying a higher price and I'm still paying GST. So increasingly, the companies want their vendors, and this is particularly B2B. In B2C, it's different. But in B2B, most companies are insisting their vendors are GST registered. You will find this as you grow. Audio not very feeble. Agriculture, I've answered that. Okay, great. Very good presentation. Fine. Let me see any other new question before I move on. I'm a paint retailer. If I supply and apply, can I use ITC of paint for service portion? Yes, you can. If you are GST registered, I repeat, see, the thing is very, very broad. If you are GST registered and your end product attracts GST, then anything that you do, any material that you buy, which goes towards the end product, use in the end product, you can get credit for that. It doesn't matter service. You buy a paint at, let's say, 100 rupees a liter. And then you do a painting for somebody based on the square feet of the wall or something like that. And you charge him a GST on that. You can take a set off of the paint that you make. Drilling a borewell, somebody has clarified that this is a service and a provision that activities on agriculture is provided. See, the problem here when it is a service is you got to identify specific agriculture. All borewell activity will not be deemed to be agriculture because borewell can be done non-agriculture also. So therefore, you will have to specifically go into the act and claim an exemption where you're doing agricultural activity and non-agriculture. Cases where exemptions are given, the onus of proving the exemption comes on the person making the GST. Okay. Both are selling for 10. MRP is 10 all over India. So GST and non-GST, both are buying for 7. Both are. See, when you buy from a distributor, if you're a trade, I am presuming you're talking of being a trader in biscuits. If you are a trader, then the MRP applies. And it doesn't matter what you buy. If you buy including GST or without GST, you can't sell above the MRP price because you can't get a credit for the GST. That's where the problem comes, which is why the tendency is for more and more people to get registered and take a credit and make that little extra profit than do it without trading. Anything else? At the moment, no, but this is something you would really have to think. The main point I'm leaving behind with you is GST, your accountant will tell you, is an asset. But please remember, it is an asset only if you can use it in your end product. If you cannot use it in your end product, then the GST amount, which even though it is sitting on the asset side, is actually a liability to you. Moving on, I'm stopping here with GST because I don't have anything else at this moment, and as it goes on, it will be, sorry, could you please share Word file for our revision purposes? Okay, some of it is towards Kannan, so I read it wrong. So I will move on. I'm moving on from GST. I now want to go back to where I left with in capital project. Sorry, so non-branded grocery items are mostly non-GST. I'm stopping this. You can send me separately. I will answer it because it can be very, very specific and I can get it. But by and large, non-branded grocery items do not have end GST. Moving on, I want to get back to capital budgeting. The reason I want to get back is, I didn't cover it last time. I told you that it is outside the scope. Now, why is it outside the scope? I told you, if I'm importing goods, say furniture or my office. Oh yeah, that's another thing. If you are building a house and if you are doing interiors to your office and doing up painting and furniture, then the problem comes in is that if you are paid GST on those materials, invariably that GST cannot be taken if your end product is actually computer services or something else. I repeat, if you're building a house and using it as an office, you're doing interiors and using it as an office with the end product being something else, then the GST that you pay on input products, you will not be able to take any credit. And finally, I'm sure aware of the difference between 3B and GSTR. One, most of you have to file 3B, those who are filing. Still, it is 3B. And 3B has to be technically filed before the 10th of next month. Though, if you file till the 20th, nobody has a problem. I'm talking normal cases. Right now, they're giving you an extension to June end. It could get delayed if the lockdown continues or whatever. That's a different story. The point, one critical aspect here, you have to pay the GST that you collect from the client, even if you've not collected it. Which means, again, my mythical example, I raise an invoice for 1,18,000 is my GST, 1,18,000, the customer has not yet paid, you have to pay. So for God's sake, make sure, if not, you have to pay interest on that GST. The customer is not going to pay you any interest. That's a straight loss from you. HR services yet to file. I've done a lot of, should I ask for a refund while I file annual GST, or ITC will be carried forward? ITC will be carried forward, so you don't have to ask for a refund in your annual GST. The refund comes inside and they have not taken a stand where it is impossible for you to use your GST. But those are specific cases. I don't want to get into that here. Moving on, we've got another 10-15 minutes left. So I would now like to, oops, sorry, what did I do? Stop share. Capital budgeting. Okay, why am I? Why is this capital budgeting important? Is I want to start off that and therefore we move on. Budgeting, we all know. I've explained budgeting last time. So I'm only talking about capital budgeting. I'm sure you can see this. Can someone say, because I'm a little lost on this. I did so many stop share and reshares. I'm assuming. Never mind. Let me just do it once again. Yeah, it should be okay now. The capital budgeting means budgeting for anything which is not your normal consumption pattern within the year. The key point is the money is paid now, I repeat, and the income comes over many years. The problem there is, let me give you some examples. Buying of machinery, setting up of new offices, you want to start a new branch, all that I explained the last time. And I told you why you can't use anything simple. You pay the money now, benefits come over the next 3 or 4 years. And I told you, you cannot compare it the way you do the normal budgeting. So how should you do about it? I just want to touch on that a little bit with you. Let me go back and go to my text write-up again so that that's a little easier for you to look at it. Problem is the costs are incurred today, income is over a few years, and there's a mismatch of time. You have to understand the time value of money. Now, unfortunately, the time value of money is probably the most difficult thing to understand. So I'm asking you, what does it mean? It's a little abstract. For those of you who have done electrical engineering will know that if you put your hand into the plug, you will get a shock, but you will see nothing. But you will still get a shock. It's like that. A time value of money, it's difficult to conceptually understand, but it gives you a shock if you don't take that into account. Examples, I told you, new location of a branch, branding of an unbranded product, anything which you spend now and you get it later. Remember, you heard of the old expression, don't add apples and oranges? Must have done it in school sometimes. Basically, what it means is that two different things cannot be added meaningfully. So let me explain. If you have one note of $1 and one note of rupees 100, can you add it and say you have money worth 101? Obviously not. It's not very silly, right? I mean, $1 plus 100 rupee note, my money is 101. Your money is not 101. So then how would you calculate what money you have? Simple. You will either convert the rupees to dollars, which is easier. You multiply by what, 76 or 77 or whatever is the rate today. So I have taken 75 here, it doesn't matter. So assuming 1 rupee is 75, you will convert that $1 into 75 rupees. And then you add the 100 rupees and say, I am worth 175. This is US dollar 1 and rupees 100 is apples and oranges. US dollar converted to Indian rupees and adding apples and apples. You can add. Same logic. Even INR and INR cannot be added. INR being Indian rupees, you cannot add if it's across time. So an Indian rupee of 2020, April 22nd, which is today's date, and a rupee of April 22nd, 2022 cannot be added. They are not the same. In fact, from a purely hard financial standpoint, you just cannot add a rupee of tomorrow to a rupee of today. And that's where your problem comes. You will understand, any of you have dealt in overnight call money markets. You will understand, forget 2 years. At 5 o'clock, the value of the rupee, and tomorrow morning after the call money rates open again, the value changes. If you try investing in any bond right now, the banker will tell you if you don't invest by 2:30, that rate is no longer valid, because then tomorrow's rate will come into the picture and the rate is different. So every night the rate changes. What are we talking about? 2 years. The problem comes in CBS, expenses is in 2020 and revenues in 2022. I've already said you cannot add it directly. Then how do you do it? So I'll give you a very trivial example. I'm placing my cursor here. Let me color it. So it's more easy. So if I spend 100 today and get 50 next year in 2021 and get another 50 a year after that, can I say I have recovered my money in 2 years? I've given you the answer. I cannot say. Well, I'm asking you, can I say I've recovered the money in 2 years? Because I spent 100. I got back 100. No profit. Doesn't matter. I'm not interested in profit. I'm a charitable fellow. Spent 100. I got back 100. No. You can't say, oh, if you're purely charitable, then spend 100. Why do you want to get 100 back? Give the 100 away to somebody like that. That part is okay. But if from a business point of view, you cannot say you have broken even. To do that, you must do what you did to the USD. What did you do to the USD? You did a conversion. You did a conversion and then added it to INR. In the same way, you must convert the money of any particular year, whether it's 2021, 22. I'm taking a year. I'm not taking call money rates. It gets very confusing. And bring it down. The 2022, 23, 24 rupees, bring it down to 2020 rupees. And then you can add and compare. Actually, this is not very difficult. The Excel spreadsheets are there to do that for you. But the point is, you must understand, for those of you who are computer inclined, or even those otherwise, you're familiar with the word GIGO, right? You put a garbage in, you get a garbage out. So if you don't know what figures you are entering, you're likely to get a completely wrong figure. In this context, let me take you across to an example. What happened here? I will take you to Excel, which I have opened. Okay, this is very simple answer. Let's not get carried away with the right or wrong of the thing. But I want you to understand this clearly, because those of you who are contemplating, maybe not immediately, but even after 6 months, contemplating on investing in something for which the revenues are over a period, how do you evaluate? Now, let's take an investment. We've got about 7-8 minutes. I'll finish it within the time. Years 1, 2, 3, 4, 5. So I'm just assuming whatever you're investing, you're looking at a 5-year time span. The year 0 means now. In finance, normally when we mean year 0, we say now. Or instead of the word now, you say year 0. Investment is 1,000. Clear. I've spent 500 rupee notes. Matter over. Given it to somebody for whatever it is. Now the revenue, these revenues where you're seeing like the thing move, the cursor moves, these are all assumed revenue. This is why you're doing. Why are you doing? Let us say this is a new branch you're opening. You're spending 1,000 rupees on doing the new branch. Then obviously you want to know what revenues are going to come from the branch. Because if you have no idea what's going to come from the branch, my honest suggestion is to you, don't invest in the branch. So you have to know what is coming, whether it is a branch or a brand. You got to know what's coming in the next 5 years approximately. More important, you will know if it follows below a particular level where you are. So I'm just taking some random example. The numbers can change. 140, 275, 350, 500. You look at the total revenue. It's 1,865, which is much higher than 1,000. So I should be very happy, right? I'm spending 1,000. I'm getting back 1,865. The catch is I'm getting it back over 5 years. And even intuitively, let us say I remove 0, 0, 0, 0 and put only in the 5th year you're getting 1,865. This total will still remain 1,865. But how many of you would like to do business where I spend 1,000 rupees today, don't get any money for 4 years and get 1,865 in the 5th year? This is what we do in fixed deposits. When you go to a bank and go for a cumulative fixed deposit of 3 years, 4 years, whatever, what does the bank tell you? Give me 1 lakh right now, and after 3 years, I'll give you back so much. In between, don't ask me. I will not give you anything. That's okay. We trust the bank. Therefore, I don't mind waiting. But this is business. I can't have zero revenue there. Now, the net cash flow, this is minus, because in year 0, I've just taken this minus that. That is the revenue minus investment. So it becomes minus 1,000. All the others are just repetition because investment is 0. Very simple, as I said. The reality is far more complicated. Now comes the problem. So far easy. Now rate required is 12%. I have put randomly 12. Why 12? It could be because your rate of borrowing, your bank rate is 12, or your friends are lending it to you at 12. So there is some basis for you saying, I must get at least this much, otherwise I am finished. I am borrowing at 12, I must get a return of 12. So I have put 12. Then I see what happens. Obviously, now this is where the small mathematics comes in, but you don't have to worry about mathematics. It's all there in the Excel spreadsheet. I only want you to understand. So don't worry about the mathematics. Intuitively, you can see that this 600, 5 years later, at 12%, is worth only 340 today. I repeat, a 600 in actual rupees 5 years from now is worth only 340 rupees today. You see, 260 rupees have disappeared. Where has it gone? It's gone because you are discounting it. You're saying 5 years, my God, I would have earned at 12% or earned so much. So please remove all that return. I'm getting 340. If you look at it arithmetically, the formulas up there, don't worry about the formula. Understand the principle. Now, if I look at it, all these figures come down. You will see this difference is the lowest. 140 has come to 125. The same ratio doesn't apply because 600 is more than 4 times 140. Logically, therefore, this should be 4 times that, which means 125 into 4 should have been close to 500. But it's not 500, it is 340. As the number of years increase, it will keep getting less and less. So this is what is worth today. This I cannot add. This is apples and oranges. This is year 5 money, year 4 money, year 3 money, year 2 money. I can't add. This is year 0 money. All these are year 0 money. So I now add. You are familiar with present value, even if you're not. Now I have spent minus 1,000. I have got all this money. And therefore, I've got a positive 251, which means at 12%, if I can borrow money at 12%, this project is worth doing. The problem comes, at 12% it is worth doing. You will see here, if your requirement goes down, you don't even want 12%, you're happy with 10%. You see this 251 becomes 331. If you're happy with 0%, let me just explain how the system works. You notice this 600 here remains 600. Because then the time value of money, basically what you are saying is money has no time value. Now, this doesn't exist in real life, but if you say that, it is equivalent of saying your required return is 0, in which case the 600 remains 600. This doesn't exist. So if you put some practical percentage, I put 12, you can put anything, you find it's positive. Now the question comes in, okay? Another 5 minutes, right? The question comes in, therefore, is how much higher? Suppose I have to borrow at 14%, 15%, etc. Is it still worth it? That's what comes here. I'm now stopping here because, as I said, capital budgeting is a longer feature. This foreign exchange, there are many things which we have not been able to cover. If you have time, we will look into it. I'm stopping here. All I'm saying is, please do this mathematics before you decide whether to invest or not. There are some comments, so please, I'm just looking at some of the comments here. Your mail ID, please go ahead with your slides. 3B. There are no comments on. Did I got it wrong or? Okay, since there are no questions as of now that I cannot see any, I'm now moving on and handing over the baton to Kannan to proceed with the closing remarks of the day. Thank you all so much. Kannan, can you please take over? Kannan, you're on mute. If I'm still not on mute, somebody has said, can we break this worksheet into quarters or months? Yes, most certainly you can break it down to anything, even a day if you want to.
Yeah, thank you, Jagan, for handling GST in a very practical way and also explaining with a very good example on capital budgeting. Very interesting to see that people can actually work out that whenever they want to invest. And dear friends, the session, we are almost coming closer to fourth session. And in my session, not many questions have come. There's one question, what is entry barrier and cap table? Just I'll take only 1 minute to explain what is cap table is. Suppose you are the promoter, there are 1 lakh shares, you hold all the shares. That means you own 100%. Then out of 1 lakh shares, you give 50,000 shares to somebody, both of you hold 50%. This is called cap table. Suppose an investor comes, the company is allotting 50,000 shares to him, then 3 people are holding 50. That means each one is holding 33.33%. This is a cap table. As you allot more and more shares, you get diluted. For example, you had 100%, then you became 50%, now you are 33%. This dilution happens. Cap table is a simple format which explains who is holding what percentage of shares in the company. I think that clarifies that. Next, talking about entry barrier, you said, for example, you are doing a business which anybody can do just like that. That means it has got a very weak entry barrier. Then I have developed a technology for even for somebody to understand and bring it, it will take a lot of time. That means you are creating entry barrier. So investors will have confidence in you because there won't be much competition. Or you have developed an IP, or probably you have come out with a new formula which is not available for others, or others have to do a lot of research to find out, or you have patented this, then there won't be many people trying to do your business. That means the entry barrier is very high there. This is about entry barrier. And some of you have asked about details about venture intelligence. I have given the email ID, please write to them. You will get a free directory of investors. And Mr. Arun or Mr. Ashok will also respond to you. If you have any questions, you can ask them. I think with this, we are completing our 4 sessions. And I thank the faculty team. Aparna handled the first and second session, and Mr. Jagan, who has handled capital budgeting and GST today. Thank you very much, Aparna, and thank you very much, Jagan. I also thank Saurav, Priya, and the secretariat team, and also Executive Director, Akila Rajeshwar, for organizing this. I thank all the participants for very patient listening. And if it is possible, we'll once again come out with one more session soon. Thank you very much. Over to Saurav.
Yes, sir. Thank you so much for handling 4 sessions. I thank Ms. Aparna as well as Sir Jagan for giving our members this opportunity. So we'll definitely be planning for another session very soon, because we've already had participants coming in and they want a lot of other financial sessions too. So with that, I would like to end the meeting. So thank you all for being a part of it. Thank you, sir.